Hey, what's up, guys? Welcome to the Truth About Real Estate podcast. Today we have special guest Jeff Love from Gibbs Giden Attorneys at Law in Southern California. He focuses on real estate and investing, and that encompasses, real estate transactions, including negotiations, purchase contracts, sales, syndication, and financial transactions. Welcome to the show. So glad to have you here.
I'm happy to be here. Thanks for having me.
Yeah, so let's learn more about you. We had a quick conversation at first, and you've been a real estate lawyer since 2009. How did you even get into real estate law?
Well, back in kind of college, I'd look at family, friends, trying to decide what I wanted to do, like most people that age. And I saw people investing in real estate, you know, not just wealthy and making money, but really were entrepreneurs buying and selling. I liked seeing something come of nothing. Like blocks as a kid, people were building buildings, developing, and that really stuck with me. So I decided to go to law school with the intent to be a real estate developer, but I wanted to learn about the law. I wanted to understand contracts so I could, know what I was reading and understand everything. Somewhere along the way, I went through law school, learned about real estate transactions, corporate transactions in general, and after graduating, it was a downturn. So people didn't want a transactional attorney, much less in real estate. So I worked at two different companies. The first was a recycling company as a general counsel, helping them with their corporate transactions and doing a little bit of real estate, lease here, purchase there. And then I eventually left to get more into real estate. I joined a real estate development company as, again, in-house attorney, and they owned about 18 million square feet of retail and industrial space throughout the country. And I was doing leases, purchases, and sales, creating companies to hold the real estate, looking at title and easements, really anything and everything to do with real estate. And I loved it. And that point I realized that I wanted to work with more clients, big ones, small ones in different stages. And I like being behind the scenes rather than being the developer myself. We're getting to work on different projects. I realized I do like being the attorney behind the scenes. So I joined my current firm and have been doing this type of work ever since, real estate and corporate work for clients of all different sizes.
Is it like real estate law? Is it completely different from corporate law, patent law, business law? What do you think about that?
It is very similar to business and corporate law. So what I do are transactions. I don't do any litigation, so I never got to go to court. Nothing like the lawyers you see on TV, Law and Order and those type of shows. What I do is I deal with paper a lot and negotiate deals. So someone's buying a building and I will help them draft the purchase agreement with all the essential business and legal terms and then negotiate it with the other side and help them through the entire transaction through looking at leases and due diligence, anything that comes up. And the same thing is really the same with business or corporate law. Instead of buying a building, you may be buying a business. So you're doing a similar purchase agreement and your due diligence, instead of on a piece of property, your dirt is on a business and their contracts, their employees, their business plan. So the business and corporate law, which are kind of interchangeable, are very similar to real estate transactions. There are big differences between these areas in patent law or trademark or employment law, but there is a big crossover between corporate and real estate. And even with the client, it may be a business client, and one day we're helping them with negotiating a contract with a vendor, and the next day they're doing a lease. So for that same client, we may be doing both types of work, whether it's corporate or real estate transactions.
I think real estate law is a lot of fun. Like, even though I'm not a lawyer, I like contracts. I like the negotiation. I like learning about all different aspects of the real estate transaction side of it. And especially when you get to work with lawyers, talk to lawyers, and understand how they think about things, where they see different gray holes, and how they interact with other clients, especially in commercial real estate. There's so many different ways you can draft a contract, and there's so many different variables for each property type that you want a really good lawyer who has the experience to make sure they're covering everything you can think of. And I've seen some really crazy like letter of intents, like super complex but simplified in a way. And once they kind of go back and forth with a letter and everyone agrees, they draft it with lawyers. But even then, when you look at how they write things, sometimes you can tell they're using some tricky words that kind of can put you in different situations, and that's where your lawyer comes in and says, hey, let's rewrite this, let's negotiate it this way, and make sure it's super clear on both sides. But it's really interesting topic, and also you have to be really meticulous about making sure you're covering every single thing.
You're absolutely right. And a really good lawyer can get those points across,
Mhm.
but do it without using legalese, which is those complex legal words. There are better ways to say it that is clear and that everyone can understand. And a good lawyer can take that complex concept and simplify it so everyone can understand. But one of our jobs is to, analyze risk and exposure. So while the client may want, I really want to buy this building, it's a great business deal, they may not be thinking, well, there's a gas station next door, and what type of environmental liability does that expose me to? Or what type of condition is the building in? It's not just numbers, and the real estate lawyer's job is to kind of quantify those risks, explain it to the client, and let the client make an informed decision, whether they're a buyer or seller or a tenant, before they enter into that transaction, and help them mitigate that risk, whether it's through using different entities or changing contract terms to make sure that you are getting your business deal, but we're limiting as much risk as you can and making it a qualified risk that makes it a better transaction and better business deal.
I think one thing too, like some of the misconceptions I see when I work with clientele is like, when you deal with lawyers, of course, lawyers win in the sense that, they're taking your money. The second part of it is that, there's so many different price ranges from example, 250 an hour to 650 an hour or plus. And then how do you justify the differences? And even though someone charges more, is it because they have better marketing, better sales, or actually better experience? And it confuses people, clients, buyers and sellers on the transaction. And sometimes you say, you get what you pay for, and hopefully you can get someone to do it. And then there's also the part of, okay, what's the lawyer's goal? Is it to hopefully get you out of any issues quickly, fast, and cheap as possible, to make sure you're covering your base, but also not going to a exorbitant amount of spending to get what you want? And there's different types of lawyers. Like some want to just fight for what's right rather than what's cost effective. Some are like, let me just get you in and out the fastest way possible, especially for like buyouts, evictions, LS Act, or other agreements.
Yes, those are all great points, and they're different types of attorneys with any profession. You've got good ones, and fortunately there are some that are not as good. And what you don't want is an attorney that is going to bill just a bill, or that's going to wordsmith a document, you know, driving up the cost, even if it makes it perfect. When you, from a business standpoint, you want to be efficient, you want something that works, but you need to be cost sensitive. And spending that extra couple $1,000s to fine tune one provision when it doesn't have a material business or legal impact may not be important to the client, and that's something the attorney needs to realize. On fees, you make a great point. Some of the times the fees are driven by geography. Just an attorney in Los Angeles or San Francisco, may be cheaper than an attorney in Salt Lake City or Houston. Depending where the attorney is, that's a driver on rates. A new attorney that has 2 years of practice is going to be significantly cheaper than one with 10 or 15 or 30 years of experience. The more experienced the attorney, the higher the rate is going to go. What you want to do is you want an attorney that you feel comfortable with, because you may say, okay, I'm going to pay this attorney $500 an hour and this attorney charges $250. But how long is the $500 an hour attorney going to take to do my assignment versus the one that's $250? If
Yeah.
500 can do it in an hour, but this other attorney at 250 is going to take 3 hours, the more expensive attorney is more efficient and will actually be cheaper to you. So
Yeah.
it is kind of, you get what you pay for in a sense, but it's also about efficiency, the attorney's experience, and their experience in what you're doing. What we like to do is always offer clients, a fixed fee if we can, or budgets. So sometimes we can't predict how much the other side is going to negotiate. So it wouldn't be fair to say it's going to cost $1,000 because we just don't know. But what we can do is we can offer a budget and keep the client informed. Because what I like to do is I never want someone upset about a bill. So I like to keep them in the loop as to what we're spending and how much time it's taking, and work within that budget to get them the results that they want. So these are questions you should ask an attorney when you're engaging them so that you understand the relationship and that there's never any surprises.
Great points, and it really does make sense. And I think some of the hard challenges for some clients is that some attorneys actually have a consulting fee. So, oh, you want to talk to me just to get to know me? I'm going to charge you my hourly rate at 250 to 450 or plus. I'm like, really, it's hard. Like, I can't even get a 15-minute conversation just to ask a question and see how you work to get an estimate. Some are, no, I'm busy, So then, of course, you don't have to work with them, but we hear they're good lawyers too. So it just gets difficult. Who do you choose up front without knowing really your situation and how to deal with it with that lawyer and their personal experience on that kind of type?
It's hard, and that's a good point from both sides. Attorneys, we typically bill by the hour, so spending even half an hour with a prospective client is, it does cost money, and it's half an hour that you couldn't spend on another client. That said, we never charge for consultations because we want the client to get to know us and see if you want to engage us. And well, me personally, I wouldn't spend an hour on a phone getting to know a client. Sure, 10, 15, 20, 30 minutes, because I want to show you that, our experience, that, we know what we're talking about, how we work, make sure you're comfortable with it, and then engage. Because some attorneys, what I think what kind of separates, us and some attorneys is you're in it for a long-term relationship. So devoting that 15 or 20 minutes up front for a 5, 10, 15-year relationship is something that's worth doing. Where if you're doing one assignment and you never hear from that client again, that's maybe some attorneys' business plans, but the way kind of I operate is it's an investment on both sides. Your
Yeah,
client
I agree.
taking time to interview different attorneys. You don't know that one's right. You may be referred to this person, but you want it. It's a two-way interview.
Yeah, I completely agree because you want to know the client too. And also the fact is, I think one thing that helps too, if you have a really good real estate agent or a team who has a, kind of like a council or like a team of vendors who they work with and constantly provide business to each other, those lawyers know that, hey, the real estate agent always, refers good clients to us, helps each other. They understand the situation, understand how to work together, what makes sense, and have a really valuable team to help clients. And that helps, like, for example, CPA, your lawyer, your escrow, your vendors, inspectors, whatever. But having a team formed around helping your clients makes it a lot stronger because you can have a trusted real estate attorney kind of guide them through the process, and you kind of know upfront what they need to do that. And I think one thing I tell my clients too is that when you work with a real estate attorney, I personally prefer always working with the attorney directly rather than their associates. I know sometimes the associates are cheaper upfront, and then the attorney will review afterwards. But sometimes you can tell for some lawyers, they're so busy that they actually don't work with you and they just hand it off all the way to the end. And that's actually not the most beneficial or cost effective for the client themselves, especially on a complex transaction.
That's right, and that's something, we use associates as well, and it's a client by client situation. Sometimes there are benefits to using an associate at a lower rate and having a partner review it, but you're absolutely right. In a complex deal, that attorney may be rewriting everything or reviewing it. So it's a question that you can ask up front and tell the attorney what you want. But you make, great points about a team as well. We tell our clients the same thing, not just an attorney, but with real estate investing, one of the biggest mistakes that I see clients make is not having a proper team in place. You used it in the context of kind of referring to an attorney, but I think, you have a good real estate agent or an accountant and insurance broker, because you're relying on these professionals to help you in areas that you don't know, and having that team in place is going to make you a better real estate investor because you're able to rely on other people's expertise as well. And that team may have worked with each other before. If there's a referral, we get a lot of our work from referrals because someone will work with us and say, I like this person, I know this person, I trust them. They're able to handle the deal that you have. And when I get a referral from that person, I know that that person's going to refer someone that they trust as well. So we're already starting off at a more beneficial relationship because there's that, we both trust that person in common, rather than if someone were just to call me or I were to meet a potential client. We have that mutual source between us that we both trust and like.
Exactly. And like having brand advocates who actually do business with you actually generates you like a 7 times growth in terms of referrals. Like that person who works with you, you have a good relationship, good business, and you work well together. They're going to give you like 7 more clients at least. And then that can keep expanding throughout multiple levels. And that's just a great way to handle business. build it by relationship as well as new prospects. But that trust and long-term relationship adds so much long-term value that it's something really to appreciate over time. And hopefully good people work with you that have not too crazy deals, right? Or hairy. So one thing we saw too is that even though you're a real estate attorney, you actually got your broker's license as well. But as an attorney, I don't know, do you necessarily need it in terms of contract law but versus real estate practice?
No, you don't.
Yeah.
I use my real estate broker's license on the side. I invest in real estate as well. So sometimes I'll use that to either, every now and then maybe represent a client in a separate context, or use it for myself to put offers on different buildings. To be in a practice real estate law, you need your license to practice law. To be a real estate broker, you need to pass the brokerage test with the Department of Real Estate. I got it because I was able to, with practicing law, you're able to do it without the special education classes because we already have that. And I use it for different contexts, but it's helpful because, I've done brokerage in the past. So I'm able to relate to brokers, understand their needs, and also work with them because I have that license and I have practiced in that field before.
Nice. And I think it's great that you have, you're a broker as well as, you practice real estate law. So you kind of see more things than normal people do, and you understand it, in the complexity it can be. And I'm sure you try to simplify it so everyone can understand it and not make it, yeah, too wordy for them to deal with. But have you started investing in real estate first, or did you get your license first for law?
I got my license to practice law first. I've started investing the last few years, and it was really driven by looking at clients and seeing what they're investing in, learning that taking some excess cash, and instead of investing in equities or stock market, bonds, real estate was a great source to accumulate wealth and passive cash flow. So what I did is, myself and my wife, we actually took some of that money and bought an apartment building close to our house that we manage. And, our investment strategy is really to leave, to grow that wealth and leave to our kids. Everyone's different, but I'm able to use kind of the real estate law and, as a kind of a side business or just an investment strategy, invest in real estate as well.
I'm glad you're doing that too, because real estate, I think for me, like real estate investing is one of the most important things to do, and especially to teach your kids and able to provide to your kids. Creating that passive income and cash flow will help provide college funds easier, I think, and that one day you can hand off these properties to the kids, if they're lucky. And if you buy some single family homes for them in the future too, you can kind of help guarantee for yourself as a parent later that hopefully they live close to you and you can, take care of the grandkids and have fun, right?
Yeah, there's so many benefits to it, not just from the tax deduction, but whatever your strategy is, whether it's value add real estate and I'm focusing on cash flow. Ours is a little bit different because it's more of a long term investment. With a residential paper that it's 4-unit building, but that enables will grow in value over time. We're actually able to gift some of it already to our kids, and they'll learn as they get older about any distributions they get. They have to manage their money, use that for college, and eventually be able to inherit this building. Hopefully be able to buy more in the future and use that as a way to grow wealth and pass it on to the next generation, apart from our, my wife and myself's day jobs.
Yeah, and I love it. I started investing in real estate when I was 24 and bought San Francisco real estate, and it was a lot of work and a lot of fun and some risk involved, of course. But I think that it's so much easier in a sense of if you can save and build, and even if you do a low down payment and get in the door, that over time, the equity appreciation, the constant cash flow, hopefully you're getting good positive cash flow, and then just waiting and just keep saving and keep building and buying your next one over and over. Will help you grow tremendously versus a job. A job is pretty stabilized over time, is still going like this, but the benefit of passive income, tax depreciation, and the equity growth alone is tremendous, right?
You're right, and you've hit the multiple components. It's not just appreciation over time, but you also have cash flow coming in
Mhm.
and depreciation. So you're kind of making money three different ways. For it may be passive, you may be managing it, so it might be a separate business. However, you're operating it, but you are be able to take advantage of all three of those versus a salary and a job that you are working in based on your hours, where real estate, you could potentially making money while you sleep, which is the same, with passive income. It's something that you invest in and you are getting returns on that money.
That's like Warren Buffett. You got to make money while you sleep, and you got to learn how to create passive incomes. Otherwise, you're just going to be on a hamster wheel all day forever, right?
That's right. And real estate, as you kind of grow in your kind of investment career, real estate is an important asset class. It would be a mistake to just invest in, equities or in companies or bonds, or for that matter, just in real estate. It's good to have a diversified portfolio. And, a lot of my clients, they have big chunks of their portfolios in real estate because they've realized the value of it, whether it's residential in an apartment building, or it's a retail property, or office, industrial, mobile home. There's a lot of different assets in real estate that you could use to even further diversify your real estate portfolio.
Very true. And for me, when I look at real estate, I love multi-unit real estate. I love the growth in even commercial multi-unit real estate versus the direct commercial. And one thing I mentioned to a lot of agents of mine is like, if you go into commercial real estate, you're dealing with businesses, you're dealing with retail offices. Those eventually could shut down. And that was pre-pandemic. Even 10 years ago, I was always talking about that. And I'm like, look at your vacancy factor, look at the risk, and look at your TI, and dealing with those kind of things and long-term vacancy. Those factors alone can be really cause a lot of headache, right, in dealing with that, versus in commercial multi-unit real estate. People need to live, they need a place to stay, they're willing to pay for it over time. Your vacancy is way lower, and then your growth, hopefully, in equity and cash flow will be better. Even though commercial real estate, less work in a sense that the tenant takes care of everything. If you have a triple net, they take care of everything. But in a sense, how do you feel about the commercial versus the apartment side of real estate?
I think there's pros and cons to each. I mean, right now, retail is really suffering, and so is office. And there's going to be a big shift in what some of these buildings are going to have to do, and the owners of them are going to have to do to deal with the vacancy that's undoubtedly coming. Residential, you're right. People always need a place to live, especially if it's in a good location by their source of business. But the downside of residential in some cities, you have rent control, you have new restrictions on that. But especially in LA County, where I am, really California in general, and big cities, you have a housing shortage, so people will need a place to live. So I think, well, pros and cons to each. I am a big fan of residential as an asset class, especially not just the 2 to 4 units, because you can treat it as residential in terms of debt, but the more units you get, the more leverage you have on that piece of land. So it is a good asset class to do, and it's one that's familiar. If it's your first investment, you may not understand triple net or dealing with a broker to lease to a retail tenant, or have the funds to buy an office building or a big industrial park. But to go and buy your first single family residence or a duplex to use as an investment may be easier, and you're able to get your feet wet with real estate investment and kind of, as you said earlier, grow and buy another one, and maybe sell that duplex and buy a 4 unit building and an 8 unit. And there are tax strategies, including a 1031 exchange, that allow you to do that and roll over your tax basis so that you're able to exchange into bigger properties and grow your investment.
Nice. Yeah, completely agree with that. So now, let's talk about the real estate law side of things. So when you look at people doing transactions, what are the common things you see in terms of like negotiations, or some mistakes, things people should be aware of upfront when they're getting into real estate?
One of the biggest ones, and it's not necessarily on a contract basis, but which I could cover, but on a high level, is really not thinking ahead. So I've got a lot of clients that want to start investing in real estate, and they may do it with a partner, but they don't really think about what's my 3 or 5 or 10 year plan. Just last week, I had to deal with, quote unquote, what I'll call a business divorce between two partners in a real estate business, because one was younger and one was much older. And the older one wanted to take the cash out of the business, kind of move towards retirement. And the younger one wanted to keep everything in and grow. And as a 50-50 partners, it eventually led to a dispute, and they couldn't agree on the future of the business. So from a high level, whether it's yourself or with partners, one or more, is thinking the future of the business. What are you going to do in terms of investing? even if you don't incorporate or organize, if I'm buying this duplex, is my goal to hold it for a couple of years and exchange it? Am I going to hold this for my kids? If I'm bringing on an investor, what's really the life cycle of this investment? Because that helps you with your business plan and really what terms of the investment you're investing in. Um, in terms of like a contract basis, you really want to look at your risk and exposure. And we kind of talked about that earlier. That's one of the areas I focus on. So for example, in a purchase agreement, let's say we're buying a 10-unit apartment building and we're the seller. Well, we want to limit our representations and warranties and our exposure once we sell the deal. We don't want to sell the deal and go on to buy a 20-unit building and then have the buyer come back and say, you didn't tell me this about the tenant, or you didn't tell me there were leaky faucets and I had $100,000 in expense and now I'm going to file a lawsuit against you. So you really want to not only limit representations you're giving in terms of a contract, but also maybe limit your liability. So I'm only going to be liable for X amount of money, no matter what. And if you're going to bring any claim, you got to do it within 6 or 12 months. So after that period of time, I'm completely done in that building. Past investment, I can wipe my hands of it. On the reverse, let's say we're a buyer. Okay, that's an important deal for the seller. But as a buyer, I really want to focus on things that may tie my hands. Do I have enough time for my due diligence period? And have I negotiated that? Because you may say, no big deal. I've got 30 days. And if I don't like the project, I can walk away. That's true. But how much money have you spent on due diligence? Have you spent money on attorney? Have you done a phase 1 or a survey or a property inspector? And you just need 10 more days to complete it, but the seller doesn't want to give it to you. Or you're caught up on a financing contingency. Your lender hasn't given you approval and you don't know whether to waive your contingencies or not. So negotiate those business terms and negotiate things with the seller. The seller may not want to give a bunch of representations and warranties, but you as the buyer want them because you want to know what the seller knows. You may not have time in your due diligence period to learn everything. It may take you 6 months after you close. So it's important to get the proper representations that the seller's, not aware of any environmental damage and that the leases they give you, the record representing are accurate. They're the owner of the building. Certain basic representations that you're able to rely on, not only through the contract, but once you actually close on the property.
I think those are all great points. And one thing I see for seller wise, sellers, of course, in the commercial side of real estate are trying to limit their exposure as much as they can. In the commercial side, they don't have to do certain disclosures as residential does. So it gives them a little more leeway, although technically they still should disclose what they know. But in the commercial side, they don't always do that. They expect the buyer to figure it out themselves. Here's the building, here's the numbers, you figure it out, and if it makes sense for you, right? So that's a little more tricky in that sense. And yeah, definitely setting your expectations as a buyer to do your full due diligence on your timeline that makes sense. But of course, the seller wants to rush you through the whole deal and get their money. So that's complicated. But even then, the hairier it gets, the more you should do your due diligence better to make sure, especially on a big transaction, because there's so many things inside you don't know until you actually go and see it and until you have the real inspectors, especially on phase 1, phase 2. And just going through every single unit, for example, or in commercial, going through all the space and checking environmental, especially in permitting and future plans to make sure that would actually work and within the timeline. So that's a little trickier on that end. For the residential side too, I see some buyers nowadays and people are going in non-contingent, but that can still be really risky because there's issues you don't know about, even though your agent like, oh, the house looks fine. It doesn't mean it's really fine. There could be issues like APN issues. There can be issues with habitability issues. There can be structural or easement issues. You don't know until you're in the deal. But by going non-contingent, just because you're in a competing offer, makes it really tough. And you're putting all the liability actually on the buyer instead of yourself or instead of the inspectors or whatever, But I see people do that all the time to win the deal.
You're right. And there's a lot of risk there. Not just, you may be tearing down the building, but what about title issues? Have you looked at title to make sure the seller actually owns the building? What if there's a big easement down the side of the property and your business model is to fix it and flip this real estate, but part of that was to expand the footprint? Well, if there's an easement, you may not be able to. So when you go non-contingent, it's really important not just to understand the structure, but you have to look at title issues. And if, instead of a single family residence, if we change this to a duplex, well, now you might have tenants. Do you understand the leases of the tenants? Your agent may say, hey, they're month to month, you can leave, but have you looked into the local rent control provisions? What if one of the tenants has a 5-year lease and you haven't actually looked at the lease ahead of time? What we counsel clients, no matter what the deal is, if there's a tenant, always get an estoppel certificate, which is a document that says the tenant will sign and essentially represent to you as the buyer, or sometimes to a bank, that what's in the lease is accurate. This is the term of the lease. This is the monthly amount. There's no defaults. Because I have had clients in the past that just look at the lease. Okay, this is what the deal is. That seems sufficient, right? But the seller inherited the property from a relative, and they don't know otherwise. And client close, and lo and behold, a couple months later, the tenant presents them with a letter from the original owner, the seller's relative, and they had a 3-year lease. The seller thought it was a year, and couldn't even raise the rent for those additional terms. And that letter superseded the lease. If we'd gotten an estoppel certificate in that context, the tenant would have had to alert us to this letter. So even though there's a potential claim against the seller, you don't want to buy a lawsuit. You don't want to deal with the headache. So you really want to do the due diligence and understand it ahead of time, especially if you're going non-contingent, because you're putting your deposit at risk. So you want to understand that maybe as much as you can at the outset. And yes, it is a competing risk with, you don't want to lose the property or the deal, but you also don't want to buy a problem. So you need to weigh the non-contingent and the timing versus buying that problem and making sure you've done all the due diligence that you can.
Yeah, and especially those, you want to have a sophisticated team who actually has experience in those kinds of areas and representation, like you, to do that. Because yeah, there is a lot of risk involved. I think having a estoppel, especially, definitely, I would say helps a lot, because they're stating what they know, what the tenant knows, what the tenant thinks about everything, and you can look at it and say, hey, actually, that doesn't make sense. That's not what we talked about. You can kind of discuss that. But if you have a lease, everything after lease could have been verbal or written somewhere in an email, and you never saw it, and they didn't give it to you, as the new buyer would not see it, right? And then you just putting yourself into issues. But I've seen some places too, they actually have estoppels, but they don't have any leases. What do you think about that?
It's usually strange. I'd rather have an estoppel than nothing,
Yeah.
but I do like a written lease, because even, in California with rent control, where you may not be able to get a tenant out for certain items, a lease helps protect you in terms of making sure, if you want to require the tenant has rental insurance, or making sure that, if they're going to have a barbecue, that it's within a certain distance from any improvements to avoid fires and to limit noise. And if there's not a lease, you're relying just on essentially California law and statutes, and the estoppel certificate can, get a representation for certain terms, but it doesn't bind the tenant to the terms that would be in a lease. So I would always encourage you, even if you're buying a building without a lease, the tenant's going to stay, try to get the seller or yourself to actually get them to sign a written lease with the terms that you need.
But in California and certain cities, the tenant doesn't have to sign any lease, because they're already in there, they're already paying you, and they can give you a estoppel, but they're not even required to sign that too sometimes.
That's right. And that, to me, a lot of times that's a red flag, that may be an investment that I don't want, because I'm not comfortable buying it without that lease, because, well, the tenant can really, they can do a lot of things that I may not want them to do. Maybe there's a common parking area and they park in the middle, and that I don't want that. Or they are smoking and I want it to be a non-smoking building, and I can't stop that. So while you're right, certain cities, if they're in there, you can't require them to sign a new lease or an estoppel. If they're not willing to, I encourage you to get it. If you can't get it, then maybe you take a step back, and that's not a property that you want. That's a business decision that the buyer ultimately has to make.
Exactly. And I usually encourage my clients, hey, don't buy into headache, try to buy opportunity, but don't buy headache as much as you can. Try to avoid it, especially if or at minimum, have a lease agreement, have exactly knowledge of who's living there, a estoppel certificate to prove it, and go from that risk alone, rather than having nothing. That's way too risky for me. I would pass on an opportunity unless you can guarantee a buyout at close of escrow and they already out, but then it's tough for those situations.
You're absolutely right. Sometimes it could be a killer deal and you're gonna make a lot of money, but how much is that headache for you for dealing with these issues? And is it drawing away from your other investments or your job? How much does that diminish the return that you're gonna get? We're all looking for that great deal, but you want to avoid the headache or a lawsuit or just administrative work, dealing with tenants and trying to get people out. To me and a lot of my clients, that's not something that we're willing to deal with. So it's kind of a risk and reward type situation and deciding if that's really a property that you want based on those factors.
Exactly. And I think like in real estate investing, there's a lot of opportunity out there. You just got to be able to find it. You don't go looking for the headaches unless it's such a great deal that makes sense. But usually I would leave those to the lawyers, like having lawyer clients who actually are investors. When you find a headache problem and they're willing to deal with it because it's their corporate law that they can do the real estate practice and they have the time and money to do it, they can make the opportunity. But for a normal buyer, seller, investor, you don't want to do that because you're not the lawyer to be able to do this whole thing at your own cost or time.
Right. Yeah, it's a great point. But that lawyer brings, that's kind of their experience and that's their job. So they're able to deal with it. Whereas if I'm a doctor or an accountant and I'm buying a property, I may not want to deal with that or have the experience to do it because it's not my job. And even as a real estate attorney, I don't want to buy a problem. Life's short. I've want to deal with practicing law and my investors making money. I don't want to buy, even if I'm capable of dealing with it, I may not want to. In that
Yeah.
case, I'm going to weigh how good of an investment is this property versus this headache that I might be buying. And if the one hand isn't a lot bigger, higher than the other one, that might be a property that I pass on.
That makes sense, and I agree with you. Time is really valuable, regardless of being a lawyer or not. Time is valuable. You got to make sure you're choosing the right things that can bring you opportunity. The easiest opportunities, the better. It makes more sense for me. So, what kind of tips do you recommend, or things that buyers should be aware of when they're trying to buy real estate or even investing in real estate? What should they kind of take notice of?
I think the first thing, you really want to understand the property that you're getting into. Even from a legal perspective, am I buying a single family residence or a duplex or a retail, and understanding what that involves. Because I have a lot of clients, you're watching HGTV and you're seeing someone flip a single family house. And oh, that's easy. I could do that. I've got great design taste. But what you don't see a lot of times in these shows or reading or blogs is the costs involved. You may have carrying costs because you're getting a loan on this, especially if it's private money that you don't always see in terms of profit versus what they're spending on the house and the improvements. You may not understand the insurance cost. Unless you're a contractor, you may not understand what it takes to deal with a contractor on a large scale and sticking to a budget and to time. When you're flipping a house and you've got expenses on a daily basis with interest, the more time, the more money. So really, no matter what asset, whether it's residential or retail, dealing with a retail tenant and what that involves, or office in terms of a full service building, understanding the investment is, I think, paramount.
Let's talk
Um,
about this. You actually mentioned a good topic, contractors. And when you work with contractors, of course, you want to work with a licensed contractor. But even then, when you look at their contracts, some of them are pretty simple, straightforward. Some of them are not. And one major thing I see is they don't have a timeline. For example, I get a project, I'm going to ask you for payment, 4 different payment types throughout the part of it. But at the same time, I don't have any minimum or maximum time per day, per week, per month, or even ending time. So some guys take your money up front as much as they can, and they'll drag it on for 4 to 6 months. They'll demo day one, they'll be gone for a month. Do you see people running into issues like that too?
you do, and a lot of it is negotiating it up front. Sometimes you're unable to, and that's just the function of if I want to deal with this contractor in this situation. But a lot of times when we try to do that, we try to put together a construction agreement, whether it's you know a form agreement that they've used or one that you have or that your attorney drafts. And one of the ways to what you want to do as the client is watch the costs and watch the timing. So different ways to pay a contractor. One is cost plus, where you're paying for the cost of materials plus their overhead and profit. Another one is a guaranteed maximum price, where this is a fixed sum. there are pros and cons to each. If you're using a guaranteed sum, you know what you're going to pay, but have you really outlined the materials that you're putting in? Because you don't want to think that you're getting, beautiful stainless steel appliances and the contractor puts in, used appliances because they're trying to save money because they're only getting a fixed amount versus cost plus, where it doesn't matter to them what the cost of the materials is because they're getting a 10%, addition on that. So one is negotiating how they're being paid. And one of the things we try to do is, put in, schedule of values for, what everything is going to cost, put in a schedule of time where they have to meet certain milestones and they're paid on those milestones, or use incentives or disincentives. If you're done by X date, you're going to get a 10% bonus. And sometimes that goes over, that's a lot more palatable to a contractor than if you miss this deadline, then you're going to pay me a fee as liquidated damages. So using one or the other, we've had a lot of success with incentives because if the contractor meets that date, they're going to get a bonus.
Nice.
So using a lot of different, these different mechanisms to make sure that they are motivated to get it done. So they don't take your money up front and it drags on, 3, 6 months. And it's not always avoidable, but if you have a good written agreement in place, it actually helps. It'll help you mitigate that risk and keep both parties honest and try to meet those terms of that agreement.
I think that's one of the scariest part of being an investor who actually does like fix and flips or even invest in add value, because the fact is you have to have a really good contractor that you know and trust and referred by. But even referrals can turn into nightmares, because the fact is, sometimes they need the money. Sometimes they're doing multiple projects and they're spending all their money in between, and they're not managing their books like a corporation. They're just managing it like a entrepreneur and dealing with their time issues or like calculations of each project and how to allocate each worker. Or sometimes with COVID, some workers don't want to work, and then it just causes issues to your project. And I would say that most contractors I talk to, they don't want to take a penalty on a contract agreement, and they might blame you for timing, permitting, or inspections, things like that. But if in actuality, let's say your experience, you knew the project takes 4 months, but they just dragged it on for 6 months because they have another bigger project they're going to take on, and then they delay you. So it's really hard to kind of balance it out and to find really good people also at a cost-effective rate, because some guys are like, oh, you have a nice house, I'm just going to charge you 2-3 times more just because I can, and if you want me, you want me. So that's a challenge for contracting world right now.
And those are all great points. Like I said, this disincentive, the penalty doesn't always work. Contractor just may say no. You get in with the incentive, or you have those milestones where I'm only going to pay you. Maybe here's small sum up front, but I'm only paying you when you complete these milestones and you give me the lien releases on that work. So if you do disappear for a month, that I'm able to terminate you and get another contractor to stay in, and I'm not out of pocket more than I need to be because I've only paid you for the work that you've completed. And for the contractor, they're still being paid for that work that they've done. And it does happen a lot. They may have too many projects going on. They may have employees that won't come. There may be other events that prohibit them from working. But one of the ways to help that is just open communication. Is the contractor communicates to the client, hey, this is the issue, I need more time. You might be more willing to give it, where if they just disappear. But it definitely is a balancing act, and that goes back to what we talked about as a great team. A referral may turn bad, but if you've worked with someone before and you trust that person and you have that good contractor maybe on your team because this is your second or third project and you can trust them, it alleviates a lot of the risk because they know they're going to perform like they have in the past.
Yeah. So one question, let's talk about some questions regarding like purchase contracts and legal parts. So what do you see as the main issues for buyers in a residential purchase agreements or residential contracts?
With residential contracts, what one of the biggest things I think is timing, because as you pointed out earlier, with residential, sellers do have to give a lot more disclosures. In California, at least, typically using the California Association of Realtors form, which more or less has all the provisions in there and you're familiar with it. So from a buyer, I just want to make sure that I'm aware of my timing, that, I'm able to get my due diligence done on time, that I'm not waiving contingencies before. I don't really want to waive my physical contingency and just rely on my loan contingency if I'm worried that there's going to be something happening, or if I haven't done my due diligence, or if it's a unique property and it's next, it might be residential, but it's next to a gas station and there's other work I want to do. So it's really thinking through the timing issues, and also from potentially a liability standpoint, are you planning on buying this property in your own name or an entity? If you're doing it in an entity, have you checked with your lender to make sure that you're able to get financing in that entity versus as an individual? So kind of thinking not just you, because residential typically is a simpler acquisition, not always, but generally speaking it is. But if you check with your third party consultants, with the debt or service providers, and making sure that everyone can meet those timelines so you're able to get through the transaction, and you still have time to do due diligence. Even if it's a single family home, maybe it has a tenant, maybe you have a property inspector you want to use, but they're busy and then you have to scramble to find someone else. So I think timing, especially now more than ever, is one of the keys you want to be aware of when you're entering into a residential deal to protect yourself.
Yeah, I completely agree with that. And I would add on to like really understanding, hopefully from your agent and from their lawyers, is that even with rent controls, with tenancies in place, with tenants vacating even within a 59-day period, with owners vacating within a 59-day period, with you know buying with a seller going to vacate after 59 days, dealing with COVID, dealing with many other forms of things, but having a full understanding, a good big picture, and not 100% complete or legal proof, but having a big understanding of what you're doing, how you're getting to it, what's all the solutions up front, and making sure you're comfortable with it to get into the deal before going in, and talking to your team to understand what you're doing to make sure it's a good, smart investment is one of the key factors I look at when we're helping our clients. How about for sellers? What do you look at when you're representing a seller and dealing with residential real estate?
Timing is still another big issue, among others, because with sellers, a lot of times seller might be exchanging into another property because they don't want to pay taxes. So as a seller, you don't want to get yourself stuck in the middle. You don't want to have your buyer close so you can buy your upleg. Because what happens if your buyer goes through the process and they don't waive their due diligence? Or what happens even if they waive their due diligence and they don't close? Is the deposit, if it's residential, might be 3%. Is that enough to protect you if you've put a 3% deposit on a more expensive property? And if your buyer doesn't close, can you close on that new property, or do you have to back out, making sure that you're really not caught in the middle? And residential, you have limits on limiting your liability in representations, but in the commercial context as a seller, you really want to pay attention to that. Residential, you can't as much, but you want to be aware of kind of the timing. You want to be aware of the buyer. Have you looked into them? Your agent's typically going to advise you, but how much due diligence has your agent done on this buyer? Are they really approved from their lender, or did the lender get a pre-approval and just run it through their automated system? Have you verified their finances and that they're able to close? These are a lot of issues that we run into, because especially now with so many multiple offers on homes and people are buying more, is making sure that your buyer is qualified, because you don't want to, even if you don't have an upleg, you don't really want to waste 20 days, have the property come off the market and then have to come back on if you don't have to, because you didn't do the diligence on the buyer or get appropriate information to make sure that they were qualified to actually go through the acquisition.
Very true. I think one good point I see some brokers mention, is that they want the actual proof of funds, regardless of a pre-approval or not. Because there has been times when you see some brokers, they say, yeah, the pre-approved. Oh, from the lender said it, but then of course the agent didn't know. They never asked for proof of funds. They thought they're pre-approved. The lender just wrote up a paper saying they're pre-approved and didn't really run anything.
And pre-approvals, it's not just that. It's you might be pre-approved. A pre-approval letter is still subject to verification of income and credit. So just because you potentially have the down payment or the income, the lender could still deny them. Especially with people, you may own a business and maybe that business had PPP proceeds, and well, the lender is more conservative and they're treating that as a liability. The lender may not approve you. And right now, more than ever, especially the big banks have a lot of conservative underwriting policies where They may not give the buyer credit for their current residence unless it's on the market. They may not give them credit for certain income. So really take that step and get, as you said, maybe the actual proof of the bank account, the pre-approval letter, talk to the lender, and really ask your agent to do kind of due diligence on the transaction. But it's also your job as the seller to make sure your agent has done certain things, because you may have a great agent, but you want to verify for yourself as the buyer or the seller certain items, because an agent has certain responsibilities, but they're not there to do all the due diligence for you. As a buyer or a seller, there are certain things that you either need to do yourself, or your agent may help you, but ask them to help you. Or if it's outside of their scope of work, engage that attorney or that accountant or that insurance broker to be able to help you.
Yeah, and I see that too. Like for example, you can buy a home, and you can say it's not subject to the sale of your home, but it doesn't mean you're still qualified. They're still gonna have to run two appraisals. They're gonna have to verify incomes, rentals, take the vacancy factors in place, and still qualify you. Has the lender done any of that yet? And verify your leases, existing or new leases. It gets tough into situations, but not all sellers would be aware of that, and not all agents are aware of that either. And it's tough. And you can ask the lender, but you have to kind of like really do your due diligence on the buyers at place and what they're doing, and ask the right questions to understand, to make sure you're taking the best, strongest, easiest offer, and maybe even having a backup lender too to verify. Even though my buyer might not want to do that for additional work purposes, but it's just to secure the deal.
And those are great points. It's not always the highest offer may not always be the best offer. Even whether it's all cash versus a loan, it's really, as you said, I like that. It's asking the right questions, because that's how you're able to protect yourself.
Yeah, and I believe that just comes with experience over time. And as an agent and an investor myself, it just comes with the experience to know what people have gone through, what issues agents or buyers and sellers, investors go through, and learning how to ask the right questions to see what makes the most sense. And I understand times of essence, but at the same time, understanding the full picture before accepting anything.
Absolutely.
Yeah. What do you think about real estate syndication? I know we have a few more minutes, but I would love to talk to you about real estate syndication and your thoughts on that. And like, for example, sponsors, operators, blind pools, fund to funds.
It is growing more than it ever has. Syndications, years ago, you didn't hear as much about them. They've been out decades. People have been doing them, but with changes in securities laws, and especially with all of the new crowdfunding websites, it's becoming so much more easier for us, so much easier for a sponsor, which is the person that runs the syndication, or the investors, to find each other and to do an investment. So syndication is really, I have a property and I want to raise money from different investors to be able to come up with the down payment or the entire purchase price. So I'm syndicating that investment to these various investors, and the Securities and Exchange Commission makes you comply with certain restrictions if you're raising money from an investor, because you're selling them a security. You're selling them a piece of that company, usually that owns the real estate. So they make certain restrictions, whether, you may have heard accredited investor or non-accredited investor, and that's based on certain financial parameters that the SEC has put forth. And the syndicator, if they want to sell to non-accredited investors, which may not have as much income or a net worth as an accredited investor, you're usually not permitted to advertise. So you can't do your crowdfunding websites. You can't post it on Facebook or certain social media. Whereas if you were selling to only accredited investors, you can advertise. So it opens up your investment to a much wider pool of potential investors. That's why you've really seen that explosion, because you are able to advertise, and people are able to buy real estate in other states and use that as a vehicle for additional passive income, and get a great preferred return or an IRR on their investment, which may be their savings account or the bond or mutual fund that they're currently investing in.
Yeah, I actually love real estate syndication because I see the fact is this: if you're an active investor and you're investing in 1 to 4 units or even 5+ units, you're active. You're dealing with the property, dealing with all the risks. You're dealing with the loan, the headache, the managers, the vendors. That's one way. And what cap rate are you getting? Actually, are you getting 3.5 to 6, 7, 8, maybe depending on what state you're in, what city you're in, and what kind of property type. Versus a passive investor can go into syndication and meet with sponsors, find good operators, and passively invest, and they might offer not a preferred return, and that preferred return might be greater than what you currently have. And they also have cost benefits, depreciation benefits for you to pass through the K1s, right? And that's another way. It's a different style because one is you're active, you're going to get cash flow, you're going to hope for equity, and you're going to deal with the risk involved, versus going passively into one. And that one might be a 20 unit, might be 450 unit, and the bigger it gets, hopefully the less liability, in sense of you believe it's in a good area that it will grow and you'll make money. And the difference too is who's buying these properties. Mostly institutional investors. So if you can get into the deal, in the future, if it's going to have add value, institutional buyer will probably will be interested in buying it. So if you look at the numbers and it makes sense for you, it might be less headache, less work, but you're passive instead of active.
And it's also a good diversification tool. If you had, wild example, $1 million to invest, do you buy $1 million duplex and you're paying cash for it, or do you divide that into 5 different syndications, and one might be a retail property, one is an apartment, one's in California, and one is in Denver. So you're able to diversify your portfolio, and as you said, you're no longer active, you're passive, which has pros and cons. You're not actively involved, you don't have the headache of managing it, but you are relying on that sponsor. So when you're deciding to invest in that syndication, you want to make sure that you understand not only what the sponsor is getting paid for putting the deal together, because that may come off the top, but do they have a track record, and are they qualified to be the active investor and actually run that project on your behalf, especially if they're a new investor, or they're going from, their track record is small apartment buildings and now they're buying a 100-unit apartment building. Just making sure that you understand their experience and you're comfortable, because you are passive, so you are putting your money in their hands with certain protections, but you want to make sure that they're able and willing to kind of manage the deal for you.
Yeah, and I think for syndication, something to be aware about is that there's many different types of syndicators. There's new syndicators, there's experienced syndicators, there's syndicators who do certain types of syndications of properties, and there's big kind of like institutional style syndicators. So you want to make sure you vet all the syndicators that you want to work with, and vet their experience and their knowledge and background, and the team who they're working with, and vet the team to make sure you have full understanding before you invest into their syndication. But once you get going with really good operators, then you feel more comfortable. You can slowly keep investing and watching. You can also diversify. I like the diversification because you can go to different states, different kind of economies, and figure out what's best for you, and start tracking the records of how the performance is in each area, and track the sponsor as well. So when you get more and more into it, you can diversify further as you go along. Some of the biggest names out there might be performing the worst. Some of the smallest names out there might be performing the best, but you won't know until you actually start engaging and understanding and looking at their track record to figure out what's best for you.
And you're right. And it's also different types of investments. You may be in a syndication that is doing a ground up development deal versus a value add, a core holding. It may be mobile homes. It may be a certain type of industrial property, as you said, different states. So it really, not only allows you to diversify, but see what asset class, is performing the best, and what asset class that you prefer to hold based on, your investment strategy.
Yeah, I think that gets really fun. And I think when you add that with real estate law and the full understanding of investing and trying to figure out who to work with and looking at all the details, it helps you have a better understanding of it, and hopefully make good informed decisions about each one, and just being able to be in different states way quicker and to go into bigger units. Like I'm in 3 passive ones already, and I'm working on active ones as well for syndication. It's fun because it's a different scale. Like I liked being in a 450 unit. I like being in a 150 unit. I would never be able to buy it myself at $100 million plus or $450 million. There's no way as one person easily can do that. But being a part owner of it is nice to see.
Mm-hmm. And
Yeah.
it gives you that difference. As you said, you wouldn't be able to buy it yourself, but you're able to get the return that potentially was at one point was reserved for institutional owners that had that type of cash flow to be able to buy it. You're able to get your pro rata portion of that by investing in the syndication for those larger apartment buildings.
And I think one thing, as especially as for your example, younger generation, I think the best thing is to be learn and educate yourself as fast as possible on all the different types of investing you could do, and feel comfortable with what you want to do, and figure out and ask questions, ask a lot of questions to figure out what makes sense for you and who's willing to show you or work with you and invest. So you can do that. In terms of like legality wise, I think, looking at anything you do, figuring out if you're partnering with people, if you're investing with people, if you're doing joint ventures, making sure you have you do your legal structures up front, because you don't want to just jump in, get married, and then figure it out as you go along, because everyone has a different mindset, different work ethics, and also different goals. Even if they say, yeah, the same goal, in actuality, well, it depends on the dollar amount. If what happens, you made a lot of money and one person wants to sell and you don't, right? It changes so quickly in a second, and that's when you get into legal trouble.
Yeah, that's right. It's kind of having that same mentality and making sure everyone's kind of goes back to what we talked about earlier, making sure that everyone's on the same page and you understand the goals and the strategy going forward.
I think that's the hardest part for people, is that most people say they just want to go to opportunity first. No one wants to sit down and say, let's go fill out all the paperwork, let's get married, and let's define every single part of the deal to make sure we're comfortable before we go to a deal. That's the most challenging part of it, even if your brother, sisters, married or whatever, right?
It is, and it's again, everything in law is really the risk and the reward. It's you could jump into the deal, not document anything, but if and when you run into that problem, and if you do it that way, more often than not, you do. How much does it cost to fix it? Kind of just to use a different example, I get clients all the time that maybe use an online service to create an LLC to hold real estate. And a lot of times it works, but it's never a one size fits all. So it might be a unique property in 12, 18 months, they come to me and say, hey, I formed this LLC. It doesn't work. Can you fix it? I said, yes. But, the problem is it would have been cheaper to do it at the outset than it is to fix it. So a lot of times it's, doing as much as you can. I've got a client that, very large, residential flipper. And at the very beginning, he didn't have contracts for anything. He just you started. You have to do what you do, but over time, now he's had LLCs, and now he's moved over to limited partnerships to save on taxes. He's now vertically integrated with his own construction company, own real estate brokerage, and even if he looks back on it, would probably smack himself. And how did I not have any of this protections in place years ago? But there wasn't the budget for it. So it's seeing how can I really minimize that exposure by maybe creating, one LLC, or, organizing one company, or having this one contract, and really thinking, yes, it's an expense, but how much is this upfront expense going to save me down the road? And you're weighing that versus I've got no budget for it versus I've got this and I'm able to create this, this structure that'll help me down the road.
I think one part of it too is you mentioned it's an expense. I think the key word I like to use now, it's a liability protection.
That's great. I'm going to have to borrow that because that is absolutely true. While it is, money coming in at the door, you're protecting yourself from liability in the future, whether it's creating an LLC to hold my apartment building because I'm worried that there's going to be a party and a slip and fall, and I don't want them to, be able to come after my other assets, or it's creating entities to hold two different properties because one has environmental exposure. I'm protecting myself from liability by doing certain different things, whether it's entities or contract with my contractor, or reviewing my syndication documents because I want to make sure that I'm protected from a claim against an investor or a third party in the future.
Exactly. And I know it's tough. And I think the part of it is like people, of course, we want to go to the opportunity. They don't want to deal with like, I need to learn how to do all this legal liability protections and all these other issues. I don't want to talk about it. I don't want to think about it. I just want to buy a house, right? And that's the scary part too. Yeah, I understand the opportunity, but really it is a liability protection, and you need to think of it as part of your strategy and team and expense at a certain point of protection. But that's kind of helping you, not guaranteed, but at the same time giving you some kind of, just being able to sleep at night and just say, okay, I have some protection. I have an LLC, I have insurance, I have all these things in place to protect me going forward with investment. And I use that as a way to build my team, to build more investments, because now I know I have, corporate lawyer, I have lawyers to deal with things. I have insurance, I have policies in place to kind of protect it. Not bulletproof, but it's sure better than nothing.
Absolutely is, and it helps you sleep better. And the most important thing is, if we're real estate investing to make money, we don't want to subject our other assets to a claim. So using that structure, whether it's an LLC or it's insurance, that helps us make sure that our investment is a standalone investment. And if something goes wrong there, that it doesn't affect all of our other investments. And the more you invest, the more property you have, the more successful you get, the more there is that need to protect what you've already built.
Exactly. And that's where, over time, you can start with the first one, try to do your best with what you can do, what you can afford, what makes sense. But over time, build your team up, build your lawyers up. And, like most all companies, they have a war chest, right? And they use that as protection. It's not as expense. It's just protection for them to keep growing bigger and bigger and building what they're dreaming of, rather than, hey, I need this expense to go, fight whatever.
That's right. It's a good point.
Cool. Any final things that you think our audience should know about in just getting into real estate investing, things they should just quickly be aware of? I know we already mentioned timing, I already in our contingencies to make sure they're in place, but anything else they should kind of be aware of upfront?
I think it's scary going into kind of your first investment or different property type, and it's okay to be scared. Everybody makes mistakes. I think it's the most successful clients and investors that I deal with are the people that learn from those mistakes. It's never going to go smoothly on your first or second project or investment. There's always going to be some type of little hiccup, and it's what you do when you hit that hiccup. If you learn from it and don't make it again, that's what makes you successful and able to kind of scale your projects. So I think it's not to be afraid to get into something new, but learn about it, understand it as much as you can, and especially if you do make a mistake or something goes wrong, to be able to learn from that so it doesn't happen again.
And I think for me, one thing I would mention to clients is that make sure you're working with a strong team again and that has the experience and background knowledge to help you go through these, because this is one of the biggest purchases in your lifetime. And it might be multiple purchases, but you want to make sure your team understands what you're doing and tries to help you go through those and has a vendor team to work with you through all these things. It makes you really think about it. And they're here, like we're here to guide you, to consult with you. We're not here to sell you. We're here to provide value. And you might have an agent who's your mother, brother, sister, whatever, but you want to make sure this is a big investment. Work with the people who you think is going to help you and is patient enough to guide you through this and is not here to just sell you a property. And then that would be a long-term way to keep growing your investment and not have to deal with things like, oh, that guy sold me a property, great. I just spent too much over, or I didn't see all these issues up front,
Right.
Cool. And how do people reach out to you? How do they get to work with you? What do they need to know when they want to contact you?
You can contact me through email, through the website. It's www.gibbsgiden.com. Email is jlove@gibbsgiden.com. Always happy to answer questions, talk to new clients. Anyone interested in working with me, just give me a call and I can see how I can help.
Perfect. Thanks so much for being on our show. For everyone out there, check out our podcast, The Truth About Real Estate, on YouTube, Facebook, and on, of course, Apple Podcasts and more. And we'll talk to you guys soon.